We now go a little bit further, and I'm now at this point. Okay, so I've now continued to depreciate it, and I do another revaluation, only this time the revaluation has actually gone downwards. Okay, so if my revaluation goes downwards, and let's just say it's a really, really bad one, so therefore it's now down to that point. Okay, so that is now revalued amount. And from that point on, I just depreciate it over its remaining life, all the way down to its residual value of nil at the end of its useful life. Okay. Now I can see everyone busily writing this down, so I'll just recap what I've done already. So what we did is we started off with cost, a residual value of nil, and a useful life. And what we've done is we drew a diagonal line to go from cost down to nil over that useful life, and that would be the historical depreciated cost line. We progressed down that line for a number of years, and we then undertake a revaluation, and with that revaluation we are increasing the value of the asset. Okay? On an increase in the value of the asset, we then continue to depreciate it from that point down to a nil residual value over its useful life. Okay? A little bit further on, we did another revaluation which reduces the value of this asset, okay, down to the new revalued amount. Now, one of the more important lines on this graph is actually the one we started off with, this very first depreciated historical cost line. Okay, so that line is the depreciated historical cost line. Okay, and that line becomes important, because what I want to use this graph for is to show you how we account for revaluations. And under IFRS it's actually very simple. Anything that happens above that yellow line goes to the revaluation reserve, and anything that happens below that yellow line actually goes to the income statement, or goes to profit and loss. Okay? So this revaluation first here, the first revaluation, that's going to be debit the asset, credit a revaluation surplus. Okay, so that's all happening above that yellow line, so therefore we're going to debit the asset and we're going to credit the revaluation surplus. This second revaluation downwards, okay, I'll just delete this first bit so that I've got room to write. Okay, but the second revaluation, the downward one, clearly we're going to credit the asset to reduce its value. We need to know what to debit. Well, if you notice, this first bit here, going from that level down to that level, okay, so that first part, that is all happening above the line. When we then look at the second part, all of that is happening below the line. Okay, so we're dealing with the revaluation in two parts. The top of those two lines, okay, that is the first part of the revaluation, and that is going to go to the revaluation surplus. Okay, so I've numbered that as number 1. I hope you can see that. The second part of the revaluation downwards, which I've numbered 2, that is going to go to profit or loss. So the asset is being moved from the first point, from the very top right down to the very bottom. The part of that decrease that is labelled number 1, that's going to the revaluation surplus because it's happening above the original highlighted line, above the original yellow line. The bit that's happening below that highlighted line is going to the income statement. Okay. Right, I'll just draw that section out a little bit bigger so you can see exactly what I've done. What we said was we had the original highlighted line, okay, and we had this going from there down to there. What we're saying is this part is going to be debiting the revaluation surplus. This part is going to debit the profit or loss. Okay. The credit will be to the asset. Okay. So it's just a slightly larger version for you to be able to take down of the diagram that I did earlier. So anything that's happening above the historical depreciated cost line, okay, is going to go to the revaluation surplus. Anything that's happening below that highlighted line is going to go through profit or loss. So clearly at this point you need to calculate what that number would have been, so that you know how much of it goes to the income statement and how much of it goes to profit and loss. Because to show you that earlier diagram again, I know it's getting a little bit busy now and a little bit messy, what we're saying is, as I progress down that line, okay, I get to the first revaluation where I revalue upwards, and all of that goes to the revaluation surplus. I'm then depreciating it down. I need to keep a note of what the yellow line is doing, because that is the number that I'm going to need to come back to when I do the second revaluation. So when I do the second revaluation, I need to know what this number here is. Okay? If I don't know what that number there is, then I'm not going to be able to work out what goes to the income statement and what goes to the revaluation reserve. So I'm going to need to calculate, okay, the figure that's based on the historical cost line. Because I know what that number is, and I know what that number is. Okay? What I now need to know is, what is that number there? Okay. Now that deals with upward revaluations and downward revaluations. If you have a downward revaluation, then again, if it goes down, what we're seeing is this situation here where you would use up the revaluation surplus first, with the excess going through profit or loss. Okay, right. I think it's time to throw some numbers at this just to make sure that you fully understand exactly what we're doing. So, I have an asset which cost 1,000. The residual value was nil, and the useful life is 5 years. Okay, so asset costing 1,000, residual value was nil, useful life was 5 years. Okay, so at the end of the first year, the net book value is going to be 800. Okay. Now, I can see all your heads and all your faces, so I want to see lots of smiles and lots of nods if you agree with that 800. Okay, everyone happy with that? 800 is the net book value at the end of the first year. Excellent, seeing a few nods, brilliant. Right, I now revalue to, let's say, 1,600. So I've had it valued professionally, and the person has valued it at 1,600. So therefore I need to go debit the asset with 800, and credit, it's going above the original line, so therefore credit the revaluation surplus. Okay, so I'm increasing the carrying value of the asset, okay, and I'm recognising it in a revaluation surplus. Okay. In year 2, I also depreciate, and I've now got a carrying value of 1,600 that I now need to depreciate down to nil over the remaining life, which is 4 years. So therefore I've got 400 depreciation. Okay, so I'm depreciating it over its remaining life, which is taken from 1,600 sort of down to 0 over 4 years. So I've got 400 of depreciation. Okay, so my net book value is now 1,200, which is the 1,600 minus the 400. Okay, cool. Now, here's another bit of technical stuff. You are allowed, you're not required, but you are allowed to transfer from the revaluation reserve into retained earnings any excess depreciation charge. Now this in itself is quite tricky. What we're saying is the depreciation before revaluation was 200. The depreciation after revaluation is now 400. So in other words, before I did the revaluation, I was only charging 200 of depreciation expense. As a direct result of doing the revaluation though, I'm now charging 400 of depreciation. Okay? So what I am allowed to do, and what most companies would do, is I would now transfer from the revaluation surplus to retained earnings the additional depreciation. Now I'm doing this to maintain my retained profits. Okay? So the reason I'm doing this is because I don't want to penalise my shareholders for having done the revaluation in the first place. So I'm taking some of the revaluation reserve and I'm transferring it into the retained earnings. So the revaluation reserve itself is going to reduce. So remember, I created the revaluation reserve at the end of year 1. We're now at the end of year 2, so therefore I'm going to go debit revaluation surplus 200, which is the excess, credit retained earnings. So I've still charged 200 more depreciation in my profit or loss, but I'm now transferring from the revaluation reserve into the retained earnings that extra 200. Okay? So, year 1, year 2. Net book value of the asset, if you remember, at the end of year 1 was 800. At the end of year 2 it's now 1200. Okay. The revaluation surplus, okay, remember right at the end of year 1, okay, we revalued it, so that went to 1600 with the extra 800 in the revaluation reserve. Okay, and that would be shown within equity on the balance sheet, so within the sort of share capital, share premium, retained earnings section. At the end of year 2, we've got an asset now of 1200, and we are reducing the revaluation reserve down to 600. Okay? So at the end of year 2, the asset value is 1200. The revaluation surplus sits at 600. Okay. Now, let's say at the end of year 2, we now revalue again, this time to 400. Okay, so very extreme case, but you know, it's an example, so we'll see what we do. So at the end of year 2 we now revalue it again to 400. So we need to credit the asset. Well, the asset carrying value at the moment is 1200. We need to take it down to 400. So therefore we need to take 800 off the asset. Okay? So, how do we do that? Because we need to debit something. Now, do we debit the revaluation surplus, or do we debit the income statement, or profit or loss? Well, this is where the graphs help us. So, if I do a quick graph, and you may be able to see how this works. Have an asset which cost 1,000. And I gave it a 5-year life. So therefore I was expecting it to go, okay, at the end of the first year we revalued it up to 1200. Okay, so we know that this point here, the net book value was 800. Okay, so the bit I've just highlighted in yellow, we know that that is 800. We calculated that earlier, and we revalued it up to 1200. Okay, sorry, it was 1600, my mistake. Thank you very much. Yeah, we revalued it up to 1600. Thank you for that. Okay, if we revalued it to 1600, that 800 went into the revaluation surplus because look, it's happened above that original dotted line. Okay. We then carried on depreciating it, and we will have carried on depreciating it over the same useful life. So we got to the end of year 2. And we know that the carrying value at that point, and this is not to scale, but we know that value is 1200. And we're saying we need to revalue it downwards to 400. Okay, so using the information that we've seen, we buy it for 1,000, we depreciate it a year, that gives us 800. We then revalue it up to 1,600. In year 2 we depreciate it by another year, that takes us down to 1,200. And at the end of year 2 we then have a downward revaluation where we revalue down to 400. Now if you remember what I said, anything that happens above the yellow line goes to the revaluation surplus. Anything that happens below that yellow line goes to profit or loss. So what we need to do then is we need to calculate what this number here is so that we can identify how much of it goes to the revaluation surplus and how much of it goes to profit and loss. Okay? So, what would the net book value have been at the end of year 2 if we'd never done any revaluations? Well, it cost 1,000 and we will have depreciated it by 2 years at 200 per year. So the net book value there would have been 600. So the historical cost, or depreciated historical cost, would have given us a net book value of 600. Therefore, we know that the 1,200 down to the 600, so this bit, okay, so this portion here, we know that that bit is going to go to the revaluation surplus, and we know that the bottom bit is going to go to the income statement. So in double entry terms, we know that debit the revaluation surplus with 600, debit profit or loss with the remaining 200. And we know all of that because of the graph. Okay, by drawing a little picture, it helps us understand what numbers we need to calculate. So the key thing really in this graph is that we have identified what this number here is. Okay? By working out that that was 600, that then made it so that we were able to calculate how much goes to the revaluation surplus and how much goes to the income statement. And you will notice that what was the balance on the revaluation surplus before we did all of this? Well, the revaluation surplus actually had a balance on it of 600. So what we've done is we've revalued it downwards and used up the revaluation surplus, and anything excess has gone through the income statement. And that's the rule. A downward revaluation, you would use up the revaluation surplus first, and the excess would actually go through the income statement, or would affect profit or loss. Excellent. Now, in your notes over the next couple of pages, there is an illustration which actually takes you through pretty much the same process that I've done, whereas I've just used made-up numbers, whereas they're using one. So you can work through the illustrations if you're still unclear on that one. As you can see, drawing the graph sometimes can just help you understand what it is you need to calculate before it becomes too messy. Okay, what I would sort of like to do now is just talk very briefly about sort of impairments. Okay. Now, we've almost kind of covered impairments at the same time as covering a downward revaluation, But the two things are actually quite different. And the only reason they're different is because they are caused by different things. If we are revaluing an asset, we're revaluing it down to its open market value, or its fair value. If we are looking at impairment, well, we'll see impairment in the next session, but impairment is caused when the recoverable amount of that asset goes down. And the recoverable amount is not the same as the open market value in many circumstances. So the accounting treatment for an impairment of property, plant and equipment is exactly the same as the accounting treatment for a downward revaluation. Okay? The difference is the reason why you have to do it changes, and we'll cover that in more detail in the next session when we deal with impairment. Okay, so it won't be today, it'll be when we meet again in July. Okay, so we'll get into more details on impairments then, but the thing to remember at this stage is that the accounting treatment for an impairment of property, plant and equipment is exactly the same as a downward revaluation of that asset. So anything that happens above the line, okay, anything happening up here, that's going to be treated as going to the revaluation surplus, and anything that's happening below the line, that's going to be treated as going against profits. Okay. In terms of disclosure requirements on property, plant and equipment, you are required to disclose in the note to the accounts your opening net book value, your closing net book value, and a reconciliation of how you got from the starting position to the end position. So depreciation charge in the period, additions, disposals, revaluations. Okay. And again, there's more information in your notes on disclosure requirements on page 97. Okay. So that brings us to the end, quite nicely, of chapter 7, okay, on property, plant and equipment. And what we're basically saying is we've got cost, we've got subsequent expenditure, we've got depreciation, we've got revaluation, we've got impairment and disclosure. And those are really the topics that we need to cover. All I'd say is when you're practicing multiple choice questions on this, which are at the back of each chapter, please be aware of the fact that they do have little tricks in them which will try and catch you out. Okay, especially on things like residual values that we covered earlier. Okay, so just be aware, read the questions very carefully. So what I'd like to do then again at the end of this chapter is just to open it up to yourselves for 5 minutes, just to see if you've got any questions before we move on to borrowing costs. Okay, so has anyone got any questions from any of the centres? Everybody happy with property, plant and equipment?
The management have two choices. One is you can recognize each component of an asset, or you can separately, or you can recognize just one asset. And if we go for option 1, we can recognize the subsequent expenditure for the replacement of the component. And if we go for option 2, we cannot do that. And so so in that case, the argument is that the management have choices to manipulate the earning of the company. So what's your comment on that?
Right. It's a very good question, and you're absolutely right. The thing to remember is that in order to actually separate out the component parts of an asset, they have to kind of be separable. You wouldn't be able to say, we have a building and we're going to capitalise the building brick by brick. You wouldn't be able to go to that level of detail. But for example, if you were in an area which was often struck by tornadoes, for example, if you were in Midwest USA, if you were struck by tornadoes and therefore it's quite likely your roof would get blown off at some point, you could capitalise the building separately from the roof. Okay? And that way, when the roof goes, you treat it as a disposal of an asset, and then when you pay to have a new roof put on, you can actually capitalise that cost separately. So you're right, it is up to management to decide, but you have to be able to say that it is a separable component of that asset. Okay, you wouldn't be able to do brick by brick by brick by brick. That would be taking it to an extreme case.
The argument is that So just take the airplane as an example. Like you can recognize the wings and the body of the airplane, but in case for example I am the management of the company, if I want to reduce the profits, my profit, I'm happy to recognize as one asset instead of like split them. So
Well, the thing to remember,
I got that.
sorry to interrupt. Yeah, no, that's not quite right, because the situation would be is that you would capitalise the wings and depreciate those over, say, 10 years. You would capitalise the engines and depreciate those over, say, 5 years, and you would depreciate the rest of the aircraft over 20 years. So what you're actually doing is you're still effectively taking the expense against profits. You know, for example, if you capitalised it just as a whole asset, you'd be spreading the cost of the engines over 20 years. By separating them out, you're actually spreading the cost of the engines over a much shorter period, which is 5 years, and then when you dispose of them and replace them, you capitalise those over 5 years. So in the grand scheme of things, the total expense will stay the same, because you're still capitalising the expense and depreciating over 20 years. The difference being from a sort of a peaks and troughs in terms of your income statement, because if you capitalise it separately, then you have got 1/5 of the cost of the engines every year replaced, and then every year and replaced, and every year, and so on and so forth. If you capitalise the engines as part of the aircraft as a whole over 20 years, you're then getting 1/20th of the original cost of the engines every year, but then every time you replace the engines, you're taking that one-off cost within the year where it's replaced. So year 5, year 10 and year 15, you'll have big expenses. So I take your point in the fact that management can manipulate, but in actual fact the grand scheme of the way their profit profile would work is that it actually isn't worth doing, because you end up with these big sort of lumps of expense, if you like, in years 5, 10 and 15, rather than just having an increased expense every year for the whole 20 years. Does that make sense? Are you happy with that?
Yeah, thank you.
Okay, do we have any other questions? No? Okay, right. Well,
if we do not have question, please go ahead.
Hello. Yes.
I said if we do not have any other question, please go ahead.
I have a question here.
Okay.
Yeah. Can you explain to me what's the logic behind the rules that you said about that above the line should be goes to revaluation surplus, but behind the line goes to income statement? What's the underlying logic behind that? Thank you.
It's literally saying that you would... So the question is, a very good question, is just asking for clarification on what happens above the line versus what happens below the line. Bear in mind, the line that we're referring to is just a graphical representation of the asset. The idea being is that you create a revaluation surplus when you revalue an asset upwards, okay? When you then subsequently revalue an asset downwards, what you're doing is you're going to use up the surplus that you created in the earlier revaluation, okay, before it affects profit, okay? So all you're saying is we've already recognised kind of an extra gain on that asset, and we're going to reduce that extra gain to 0 before we start taking the expense against profits. Now, when we draw that graphically, the original line, which is the depreciated historical cost line that I was highlighting in yellow, anything therefore that goes above that line is using up any surpluses that have already been created. Anything that happens below that line means that the surplus must already have gone, and therefore the excess is taken against the profits. So it's all to do with whether the downward revaluation should affect profit or loss, or whether it's going straight to reserves. And what we're basically saying is it goes to reserves if there is a revaluation reserve on that asset to utilise. If there isn't a revaluation reserve on that asset to utilise, then there's nothing we can do, and it has to go against profits. So to help you understand and do the calculations more quickly, you know, it's often easier to think of it as drawing a graph and saying anything that goes on above that original line will go through the revaluation surplus, and anything that goes below that line causes you to have to affect profits. Does that help you at all?
Yes, thank you.
Excellent. Okay, right, well, let's move on to sort of the next chapter on borrowing costs, okay, which is chapter 8. Now, we have an interesting kind of situation here, because IS 23, which covers borrowing costs, was actually revised sort of in the end of 2007. Okay. Now, the revised version is only mandatory for accounting periods commencing on or after the 1st of January 2009. Okay, so for year endings 31st of December 2009. However, that's the one that we're going to focus on. Okay, so we're going to focus on the revised version. You can adopt the revised version early. You don't have to. However, an awful lot of companies are looking at it and starting to do so. So, very quickly, prior to the revised version, you had a choice of treatments. You could either expense your borrowing costs, so your interest costs, or you could capitalise it into qualifying assets. Under the revised version, the option to expense those borrowing costs has disappeared. Okay? So now what you're left with is you must capitalise borrowing costs into qualifying assets. Now this doesn't mean every single asset, it's only qualifying assets that you capitalise it into. Okay? So, the first thing that we need to do then is we need to understand the scope, because obviously borrowing costs are incurred by pretty much every company. The question is, what constitutes a qualifying asset? Now, a qualifying asset is basically any asset that requires a substantial period of construction time. So what we are talking about then is we're talking about property, plant and equipment that you are building. Okay? So for a number of months there will be construction costs being incurred. We're also talking about things like development expenditure, so the intangible assets. If you have an intangible asset that is taking a measurable period of time to actually construct, so development cost for example, again you would capitalise the borrowing costs as part of the cost of that development. And more interestingly, how about items of inventory? Because if you are making products and those products take a substantial period of time to make, then you would actually be required to capitalise borrowing costs on that inventory. However, there is a scope exclusion. So in other words, the scope of IS 23 is restricted so that if you are producing these items of inventory on a mass-produced basis, then you don't capitalise the borrowing costs. So what we're talking about here are items of bespoke products that you're making specifically for customers. And if you're producing these things specifically for a customer, then you would be required to capitalise it. Now I'll give you an example. There's a company that I used to be involved with called Howden Donkin. Now Howden Donkin make industrial fans for mines. So if you're going down a coal mine in South Africa, for example, the chances are the air that you're breathing is being pumped by a Donkin fan. Now these fans are huge. Each fan blade is about 11 to 12 metres long. And very clearly, you don't make one of those things in a little shed in an afternoon. These things can take 8 to 12 months to actually produce. As a result of this, they're always made very bespoke, so they're always designed specifically for the ventilation system of a particular mine. As a result of that, they will now have to start including part of their interest cost on all of their borrowings as part of the cost of that item of inventory. Previously, they had the choice of capitalisation or expense. As of the 1st of January 2009, they're actually going to have to start capitalising it. I have a friend who makes furniture. Okay, so he makes handmade tables and chairs sort of in the UK. He himself is faced with a situation where, as of the 1st of January 2009, because every item of furniture that he's making is bespoke, and it's to a customer's specific order, and it might take him 2 months to make a table, for example, because it's all hand carved, then he will have to start recognising part of the cost of that table to include the finance cost, the borrowing costs. So this standard is quite far reaching, but the good news is